What if I told you that one single page, just one, can tell you whether a company is secretly broke, wildly profitable, or quietly building an empire? That page exists. It's called the balance sheet, and most people either ignore it or open it, panic, and immediately close it. Today, that changes. By the end of this video, you'll be able to look at any company's balance sheet and actually understand what it's telling you. No finance degree, no jargon, just real clear understanding. And trust me, once it clicks forever. Let's go. Okay, first things first. What even is a balance sheet? Balance sheet is one of the three most important financial documents, the other being income statement and cash flow statement. Think of it like a financial snapshot, a photo of the company's money situation taken on one specific day. And everything on a balance sheet fits into one simple equation: assets equals liabilities plus equity. Assets are everything the company owns or controls that has value. Liabilities are debts, everything the company owes to someone else. Equity is what belongs to the actual owners, the shareholders. After all, debts are paid. You can rearrange the terms and the equation becomes shareholders' equity is equal to assets minus liabilities. This makes sense intuitively, as in any business owner will get whatever is left of assets once all the liabilities are paid. Before we start throwing fancy accounting terms around, let's look at a real-world example. Imagine you are a company, and you decide to buy a house for $500,000. You've got $200,000 in cold hard cash, and you go to the bank for a loan to cover the remaining $300,000. Let's look at your personal balance sheet before you buy the house. Assets, you have $200,000 in cash. Liabilities, you have 0 loans, so this is $0. Equity. Since the cash is all yours, your equity is $200,000, perfectly balanced. Assets, $200,000, equals liabilities, $0, plus equity, $200,000. Now, boom, you buy the house. Let's look at the balance sheet after. Assets. You don't have the cash anymore, but you do have a house worth $500,000. Liabilities. You now owe the bank $300,000. Equity. Still $200,000. The $500,000 house minus the $300,000 loan. Still balanced. Assets, $500,000, equals liabilities, $300,000, plus equity, $200,000. The numbers changed, but the equation always holds. Now let's have a look at an actual balance sheet and what the line items are. Don't worry, we are going to deep dive all of these one by one. Assets are classified into current assets and non-current assets. Current assets are assets that can be converted to cash within 12 months. These include cash and cash equivalents, accounts receivables, and inventory. Non-current assets are the ones that are not supposed to be sold in next 12 months. These include property, plant, and equipments. Non-current assets also include non-tangible assets like goodwill, copyright, trademarks. Now let's move to the other side and see what liabilities are. Liabilities are the obligations the company has, and it is also divided into current and non-current liabilities. Current liabilities are the one that has to be paid within next 12 months. These include account payables, short-term debt, and taxes. Non-current liabilities are the long-term obligations like long-term debt and bonds issued. We move on to the third part of the equation, and that is shareholders' equity. This section basically shows what the owners of the company have. These include common stock, additional paid-in capital, retained earnings, treasury stocks, and accumulated other incomes. Let's try to understand the common stock first. When a company issues a share, there is a par value printed on the share certificate. In most cases, this is a small amount like 1 cent. This par value, when multiplied with all the shares in circulation, gives us the common stock value. Now that we understand what common stock is, let's move to additional paid-in capital. So in common stock, I mentioned the par value. In most cases, when a stock gets listed, the buyers pay more than the par value to own the stock. This additional paid-in capital will be reflected in the shareholders' equity as a separate line item. Let's move on to retained earnings. When a company earns profit, the owners of the company might choose to reinvest the money in the company. This amount gets reflected in increased retained earnings under shareholders' equity. Moving on to treasury stocks. In the retained earnings section, I mentioned that the owners of a company might reinvest the profits back into the company. The owners can also choose to use profits to buy back the shares from market, and thus reducing the outstanding shares. This buyback of shares comes under treasury stocks and is a negative line item in shareholders' equity. Companies do this to increase earnings per share. Accumulated other comprehensive incomes. This line item is used to hold the paper gains or losses incurred due to foreign currency fluctuations, stock market swings, pension changes, or fuel hedges. Let's take an example. The company we are discussing is a leading software and hardware company based in USA that is involved in PC software, global cloud computing, enterprise software, and artificial intelligence. We have the balance sheet of financial year 2024 and 2025 with us. I have separated the assets from liabilities and shareholders' equity for easier understanding. We can see that both sides are balanced and we have year-on-year change given in the right column. We can see that the accounts receivables have increased year-on-year. This is a good sign as this indicates that the customers are still using the product and there is even good growth in it. The next line item we can see is the inventory. We can see that inventory is decreasing year-on-year. This might be because of better demand prediction or change in software delivery method. Decreasing inventory is a good sign as it reduces the working capital for the company. In the non-current assets, we can also see jump in property, plant, and equipment line items. If we dig down the annual reports, you will get to know that there have been investments in AI tech and cloud infrastructure. We can also see increase in long-term lease by customers. This is a good indicator that the customers have committed to the products for the long term and hence some assurance of future revenue. Let's move to the liabilities and shareholders' equity section. In the short-term debt, we can see that the whole line item has been reduced to 0. This is a very good sign as this indicates no immediate debt burden and the company can work towards growth. The increase in non-current liabilities under other long-term liabilities seems like a problem. But again, we have to go to annual reports and see what is the reason behind such a jump. You will find out that the company has invested in another AI company which the management think will help in improving AI products and services. In accumulated, other comprehensive losses are also improving, which is a good thing. At this moment in time, I would like to stress upon the importance of reading balance sheet in conjunction with the management commentary. You have to understand that each industry is different and each company operates differently. Management commentary helps you build a picture of what the company is planning and what could be the future trajectory of the company. The balance sheet analysis done here was rudimentary and deeper insights can be drawn if we look at income statement and cash flow statement. If you came this far in the video, please don't hesitate to like the video and consider subscribing to the channel for more such videos.